Hello everyone, and welcome back to part number 9 of the Dividend ETF review series. Before we get to today's video, did want to throw a shout out to Cindy B. Cindy B had a really great question on a YouTube comment a couple videos ago. She said, would you talk about diversification and risk when you have hypothetically $1 million in the equity portion of your portfolio? Should I have an ETF that has, or a portfolio of ETFs that have more than 5? And then she goes on to ask about, having 20% in this ETF versus 10% split across 2. What percentage of the portfolio should we have in one ETF? Would I invest 35% in one ETF? She calls out AARK in this question. So I went in depth in this on my blog. You can read that for free. I'll put a link down in the description below. I intended to do a video on this and I just ran out of time basically. So I will do a video at some point in the future about diversification, specifically this topic. But if you want to read my comments on Cindy's question here, you can go ahead and do that on the blog. Also had a couple of other posts there as well. One on surviving stock market corrections, which we just went through a little mini correction the last couple weeks. The experimental portfolios are basically the dividend yield versus shareholder yield. That was a video I did a couple months ago. I have a couple of experimental portfolios to see whether shareholder yield or dividend yield performs the best, and then also historical elections and stock market returns, which since the election was yesterday is a little bit outdated at this point. But there are 3 articles there you guys may be interested in, so check those out if you would like. So back to today's video, we are going to be looking at the SPDR S&P Dividend ETF, ticker symbol SDY. So just like the other videos, we're going to be looking at dividend yield and fees. Then we'll take a look at the distribution history, how the SDY dividend has grown. We'll look at strategy, how SDY ends up with the stocks that it does. Look at performance in down markets and also performance going back to the early 1990s on this one. And then which stocks and sectors does SDY hold right now? So SDY is the SPDR Portfolio S&P 500 High Dividend ETF, and it tracks the S&P High Yield Dividend Aristocrats Index. So this is a bit of a blend of the VYM and the Noble portfolios. We'll get into that more in a minute. It's a pretty big fund, manages almost $16 billion. The dividend yield is about 3%, and the expense ratio is 0.35. Here's the long-term dividend history. I say long-term, basically going back to 2015 here. But you can see that the dividend generally does trend higher over time. There's a couple little cuts here and there, but for the most part the long-term trajectory here is positive, and over the course of about 5 years it is almost doubled the dividend. So pretty impressive dividend growth there. Nothing to complain about on that front. The strategy, we have a starting universe of the S&P Composite 1500, and note that most of the ETFs we've seen so far focus only on the S&P 500, which are of course the largest 500 companies in the United States, or that trade in the United States. This is the 1500, so we have an additional 1,000 stocks to choose from. A lot more small and mid caps are going to be included in this universe. They have to have increased the dividend for 20 consecutive years. The float adjusted market cap has to be $2 billion or more, so we're not getting into micro cap stocks with this ETF. The average daily volume has to be at least 5 million for 3 months. The strategy, this is weighted by dividend yield, capped at 4%. And then the basket liquidity maximum weight is a little bit confusing, but basically it sets the maximum weight of each security at whatever their 3-month volume is divided by 2 billion. So for example, if the 3-month volume was say 1% of 2 billion, then the maximum weight for that particular security would be 1%. So even if a stock had a 25% dividend yield, in accordance with this original strategy here, as we've said above, this 25% dividend yield would be weighted at 25%. However, we see that the cap is no more than 4%. So even if this had a very high volume, it would be capped at 4. This volume based, however, makes it capped even lower. So a small cap stock or something that's very thinly traded might get a lower cap of say 1%, even though it did have a very high dividend yield. That's kind of confusing, but basically there is some penalty for being a small company here. It's not going to allow, you know, a $3 billion stock to be 25% of the index. It's just would not be a good idea, and it does have certain things that prevent that from happening. It does recalculate the index until there are no stocks left at a 4% weighting. So for example, if you've got say you've got 5 stocks right now that have really high yields. So energy, for example, a lot of those companies are pushing 10% dividend yields. A lot of those are large, so ExxonMobil, Chevron, those companies would likely get a very high weighting here. So what this does is it says, okay, that would normally be so Exxon has the maximum weight of 4, Chevron has the maximum weight of 4, and you just keep coming down the list until there's no stocks left at the 4% weighting, and then we get into 3 and 2 and 1, and that's where the smaller cap names would get in there as well. So it just prevents one stock from really becoming a massive weight based on dividend yield alone. It is rebalanced quarterly in January, April, July, and October. The diversification, this ETF has no sector constraints, and it also has no minimum stock number. And then the weighting details, as we talked about, it is weighted by dividend yield with a cap at 4%. When we look at risk, we see that this fund has not performed as well on the downside as some of the others that we've seen. So far, the best downside protection has been from VIG, which had downside of about 17%. This fund was down 25%, which is similar to the Russell 1000 index here at down 26.7%. It is not as favorable as the S&P 500. As we talked about in the other videos, the S&P benefited to a great degree by owning a lot of tech stocks, which has done well in this January to March 31st, 2020 drawdown period. This fund also has pretty unfavorable upside downside capture, so it generally captures about 100% of the downside of the Russell 1000 index, and it only captures about 7.7% of that upside. Sector weightings here, there are a couple that I would point out. One, it is pretty heavily underweighted to healthcare. You've also got a double weight in utilities. Technology, again, just like we saw with Noble, is a very low weighting. Not a lot of tech stocks have raised their dividend for 20 consecutive years, so that is also very low. Everything else is really pretty close in line. You do have a little bit of an extra weighting here in industrials, but other than that, it's pretty close weighting to the large cap value funds. Here is the list of stocks. So you can see that the number 1 weighting here is AT&T. There's an energy name like we talked about earlier. When you look at this list though, like there's Chevron, you get the sense that there are a lot of kind of old and heavily indebted stocks here. I'm not impressed with the growth rate really of any of these companies. I mean, AbbVie has a decent growth rate, but it's got some patent issues. None of these names, other than maybe Old Republic, would have much of a growth rate. So that's something that is a bit concerning just from initial views here. Also a lot of leverage in a lot of these names. The performance recently has not been particularly great. You can see that over the year to date, this portfolio is down almost 10% on price, and that would be pretty bad relative to the S&P 500, which over the same time period would be up maybe slightly, a couple percent. So this has lagged quite substantially over the S&P 500. However, compared to the index, which is the Russell 1000 value, it's actually slightly outperformed. So as a value fund, this is performing decently well. It's just that value stocks have not done well at all so far in 2020, and that's reflected here with this fund. Longer term, we see that this fund has held up pretty well relative to large cap value names. Still, it's not going to have done as well as the S&P 500. However, when we look back at the actual underlying index that SDY tracks, which is the S&P High Yield Dividend Aristocrats Index, we see that it's actually done quite well. So if you look to inception at December 7th, 1999 to the 2nd of November, we see that this fund has outperformed the S&P 500 by over 3% per year, which is very impressive. However, one thing you should keep in mind is that this was basically right at the very top of the technology bubble in the late 1990s. So the S&P 500, which was comprised of basically almost half technology stocks, went on to drop about 50% over 3 years, whereas these dividend stocks did not go down nearly as much. So if we look at just starting in 2002, so after the tech bubble had already burst, we see that this fund has actually underperformed the S&P by about 0.6% per year. So I think this particular case is more of the timing of a dividend index, not necessarily it being so impressive in and of itself. It still has pretty respectable performance long term, but not nearly as good as this number would initially suggest. So the bottom line for this index, I do think long term, this is pretty impressive index performance, even considering that 2002 to 2020 period. It does have little tech exposure, which I've listed as both a pro and a con. So depending on what you think the future of the tech industry is, that could be a good thing or a bad thing. If you want to reduce exposure to tech, this could be something you would take a look at. If you really like technology, then this is obviously not the fund for you. It does do a nice job of mixing dividend yield and dividend growth history. So we saw with Noble, the 25 plus dividend year history, you had quite a bit of a lower dividend yield, whereas this fund brings that in and it gives it a dividend yield tilt. So we see here this fund yields a little bit over 3%, so a little bit more income from this one, and also that dividend growth history. It does go beyond large caps to include both small and mid, which I think is favorable if you're looking for a little bit more smaller company exposure. And then this will do well if the traditional value stocks do well in the future. This fund should participate in that. The negatives are, as we talked about just a minute ago, if you remove the tech bubble, this fund has historically underperformed. It's also a bit tilted towards lower quality stocks, as we saw in that list of top 20 holdings. The downside protection is not particularly great, and it does tilt away from momentum by focusing more on dividend yield and not being market cap weighted. You're getting less of that effect of momentum over time, which has historically been a very good predictor of future returns. So that is a negative. Future growth is pretty questionable, like I talked about earlier. And then the 0.35% fee is not bad at all. I mean, it's still a very low fee, but compared to some of the other dividend ETFs that we've seen, it is a bit higher. So thanks for watching the video. If you guys are interested in reading some of those articles, you can check out my blog at dividendgrowthmachine.com or check out the link below. If you're interested in getting updates on when the next video comes out, hit the subscribe button down below. If you found this video useful, I'd really appreciate if you give me a like or thumbs up. And what else? I am going to be doing a review of all the different ETFs that I've reviewed so far. Planning on doing one more ETF. So I'm going to be doing DVY next, and then after I do DVY, I'm going to look at all 10 of the dividend ETFs, and then I'm also going to compare those with MTUM, so the MTUM ETF that I really like, and the S&P 500 index, just so we have a basic comparison for how the dividend ETFs have done. So I'll be doing that video once I get the 10th video completed, which will hopefully be at some point next week. So anyways, stick around for that. If you want to get that video, hit the subscribe button. But yeah, that's it for this video, and I look forward to seeing you guys next time. Thanks again for watching.